It's time now for today's strategy session. Bond market investors have a new mantra: don't fight Bessent. Since heading the Treasury, Scott Bessent has focused on lowering rates and keeping them down. Strategists responding in kind by cutting their targets for the 10-year yield. The 10-year rising today, currently trading just around the 4.3 level, down about 7% since President Trump's inauguration day. Joining us now, we've got Collin Martin. He is Schwab Center for Financial Research fixed income strategist. Collin, thank you so much for being here today. I love this new mantra. We always say don't fight the Fed. Now we're saying don't fight Bessent. It kind of reminds me that we're in this moment where we're focusing a little bit more on the White House than the monetary policy from the Fed. What does that mean in terms of allocation for fixed income investors?
So even given the news from Bessent and the administration, we're not really changing our outlook right now. We favor a benchmark average duration. To put that into common terms, it just means, average maturity of 5, 6, 7 years, something like that. That's basically what the average maturity or duration of the Bloomberg Aggregate Index is. When we talk about that, it's kind of like just saying go for the S&P 500 to get exposure everywhere. That's our outlook for our clients. We don't think investors should focus on maturities that are too long because there's a lot of interest rate risk there in case interest rates rise. We don't think that they should be too short also because we think that the Fed will probably continue to cut rates a little bit later this year and into next year, so there's some reinvestment risk there also. So benchmark average duration, take what the market's giving you because we think the yields are still really attractive. You can get high quality yields of 4, 4.5, 5% or more depending on the maturity or the type of bond, but we still think that's really attractive.
So for investors here this morning that are just trying to take a step back and make the case in their own minds of fixed income versus equities when you have a pullback like we've seen, what is the case there?
Well, it's always an and case, not an or case. That's what we talk about with our clients, and we get that question all the time because we find that a lot of investors maybe are underallocated to bonds because it is complex. They don't understand them as well as they understand the stock market. So we get that question, but we always talk about bonds for the long run. And again, if we frame the market like we're seeing today, these yields are at levels that, aside from the past couple of years, we really haven't seen in 15 or 20 years. And when you look about adding bonds to a stock allocation that limits the volatility and can give you more predictive returns, so we still think they're really attractive. If you want to be tactical, then you can focus on short-term investments. Money market fund yields are still objectively attractive. You can get yields of around 4% or more with, hopefully no price volatility, and that can give you, cash if you want to be tactical, but we still think intermediate term bonds with those high yields, we think it's a great place to be today.
And it sounds like you are not too worried about the headlines coming from the White House, coming from Treasury Secretary Bessent, that you are sticking to your original plan. Is that a message that investors should be following, who are monitoring every headline coming out of the White House and obviously moving their allocations based off of those headlines? Is it better to not pay attention to the politics right now?
I'd say so, but I think it's really hard to do that today. But that's usually our outlook with bonds. They're meant to be long-term investments. We don't want our clients reacting every day with the bond market. Should I get in or should I get out? It should be a long-term view. Coming into the year, though, we thought that yields could actually be biased a little bit higher because we saw a lot of those inflationary impacts. But what we're seeing is it looks like the growth concerns are front and center more. And I think it still remains to be seen. All we know is that there's a lot of uncertainty right now. We heard that from Powell last week. He highlighted that the outlook is really uncertain, and he kind of cautioned us to take their projections with a grain of salt because those can change really quickly as well. So with that uncertainty, that's kind of why we have our benchmark average duration. So we're not making this big call, be long or be short. Take what the market's giving you, and then if we get more clarity over the next few months or quarters, then maybe we'll have a more firm duration outlook.
And so you have the Fed's preferred inflation gauge coming out this week in PCE, and one of the major things at this juncture too is just how the Fed is going to be looking through data points like that to determine what their next decision might be. And then the fixed income market also trying to best get ahead and not fight the Fed, but anticipate what that timing may look like. What is the read-through from the fixed income perspective now on all of these data points as the Fed is looking for a trend?
Yeah, every few months it's like we're looking at different things. For a while it was inflation only. Growth, labor market didn't matter because they were doing fine. Now it's much more balanced. The risks are balanced to both sides. Inflation's a little bit high, and given that the labor market has held up relatively well, we got a scare last year, but it's doing okay for now. So I think inflation is probably still their number one focus, but given all the uncertainty we're seeing, if we start to see the soft numbers, the headlines, the consumer confidence numbers translate into job losses or a significant slowdown in job growth, uptick in the unemployment rate, that's something that the Fed could pivot there to maybe protect to the downside. But right now I think it still is inflation because that's still too high, but we'll see how that evolves over the next few months when this soft data can translate into something that we can actually see in the hard data.